Hi, I'm Amy, Head of Learning and Development and Support at TradeShield.
Just a very good morning to all of you and welcome back to another Credit Thursday. If you haven't been here before, I am Amy and we have Martin online as well. I am Head of Learning and Development at TradeShield and hopefully we have come into contact. If not, then we will going forward. And in this session, it's one of the last of the series that we've been following, which is around foreign trade and how does it work with working with companies that are based outside of South Africa. And so this is the last of that series, and I'm hoping that if you did miss the first two, you can find that information on our Knowledge Center, or you can just pop us an email at support, and we will be able to share it with you, and you can go ahead and catch up on what we've done before. So let's jump into what it is that we're going to be looking at for this time, and of course quickly place ourselves in the series before we dive in. So I'm just going to give a quick recap. So in week 1 we looked at country and buyer risk. That was about assessing the market that you're in and shipping into customers, shipping to customers that are sitting inside South Africa and sitting outside South Africa. And before you extend one single rand of credit, that is what we wanted to look at. What are the risks that we should be looking at when we are assessing those companies? Then in week 2, which was last week, we moved on to VAT and tax and the implications around cross-border credit. How do we treat VAT and tax? Who gets to claim it? Withholding tax. I know there was a request to do a withholding tax session, which I will do. I will slot that in, and we'll follow that so you can get a little bit more information on what withholding tax is, and just looking at what are the implications of cross-border credit, because getting that invoice right the very first time is going to save you a lot of issues going down the line. And so for today, where we are is we're looking at currency, insurance, and structuring your deal when you are doing cross-border. So we're closing up that loop so that you can say that your risk assessment is hopefully well bundled, and that you have a good idea of how it is that you should be working when you are wanting to trade cross-border, of which we definitely encourage. We've spoken about your role. I'll come to you in a second, Martin. We've spoken about your role as a credit provider or a company that's willing to provide credit, and how you're giving somebody credit gives that business an opportunity to grow. And that, of course, extends into the individual that you're affecting, the people that are employed by the business, as well as contributing towards the country's full economy. So all over, it is a good thing to do within parameters. So to make sure that we lend not recklessly, but safely. Yes, Martin.
Amy, and it's very important to look at the 3 stages that you've gone through. The first stage is saying, okay, the country is good and the buyer is good. That might not be the end of your risk. The next risk is your VAT and your tax implications. How to deal with that? Although you've passed the first one, then you've got to make sure that the second part is working. And then the last part, the country could be good, the buyer could be good, the VAT and the tax could be good. Is there currency? Is there insurance? Is there structure? It flows into one another, and this closes that whole loop from assessing that very first bit of risk, the country and the buyer, to the very last bit. Is everything in place that I need to trade with this company?
Absolutely. And it's also looking to see, did you price your deal correctly? Because now you're also dealing with foreign currencies, exchange rates. So, and I know we've spoken about margin and making sure that your margin, if you've got smaller margins or larger margins on your items, that's taken into consideration when you are pricing your products, as well as the terms that you're willing to provide. So the margins makes a massive difference. And that's sort of the piece we're going to be filling in today, is like the financial mechanics that sit alongside everything that we've already built. So here is just a quick look at, about everything that we're going to be mapping out for you today, and so that you know where that we're headed. So we're going to start with the foreign exchange risk itself and how the rate movement actually eats into the real value and the credit that has been extended, even when the customer pays you on time and in full, because remember, you're offering terms and things change on a daily basis, unfortunately. From there, we're going to move into hedging basics, specifically forward cover. And I want to be honest with you, in this particular case, that it's worth paying attention to, even when you're not familiar with this. And of course, myself and Martin, we are not credit insurance professionals, but obviously we have had experience working alongside these companies, and so this is from our perspective. Of course, if you would like their professional opinion, I would recommend reaching out to one of those suppliers. We know a few of them. We don't necessarily have direct relationships, but we can definitely give you some recommendations if you are looking for credit insurance in the international market, because not all credit insurers actually do international as well. So there's some local and there's some international. So go have a look at that. So that's when we're going to shift into the insurance side of things, like export credit insurance. What actually can they cover, and making sure that we deliberately cover the right things as well. And then right after that, we're going to unpack the difference between political risk insurance and commercial credit insurance, because some people can mix those two things up or are completely unaware that one even exists. And so we'll cover that for you today. And then we will close with a practical part on how you actually structure your term so that this is the protection is sort of built in from the start, before you've even left, before you've even created that invoice and the stock has left your property. And as usual, pop your messages into the chat if you've got any questions. Myself or Martin or Neil will jump in when we can. Okay, so let's have a look at the foreign risk exchange. So that's where we're going to start today. And let me put a number on this, because it always makes it a little bit more real, because it's easier, at least for me, to feel it once you see it in a rand value. So say you have invoiced a customer 100,000 rand, and 60-day terms. On the day you raise that invoice, the rand is trading at, let's say, 18 rand 50 to the dollar. So in your head, you're probably going, in your management accounts, the invoice is worth 1,850,000 rand. Okay, hopefully my maths was good there. Okay, so you're writing it down saying that's what the value, because I charged maybe in US dollars, or the exchange rate was to the dollar, and that is where we are currently sitting. But then 60 days later, the customer pays you exactly on time, right? So they've got 30-day terms. That's 60 days if you count them consecutively. There's no disputes. There's no late payments. Nothing is wrong on their side at all. But in those 60 days, the rand happened to strengthen, okay, which is good in our fate. And the rate has then moved now to 17 rand 80. So now we went from 18 rand to 17 rand. So we're at a loss, okay, because the rand did strengthen. And so the same $100,000 that you were converting to 1,780,000 rand is now 70,000 rand, and it's just simply evaporated, off the value of the full invoice. So it's not got anything to do with whether the customer was creditworthy. It's not got to do with the country that they part of. There is little Marie, sorry. Sorry, there was like a little mozzie that I squished. And so, so it's not got anything to do with the fact that this customer wasn't creditworthy, that you didn't do your homework, but things are volatile, especially in South Africa, where the rand does change on a day-to-day basis. So here's the thing, that it's not bad debt, that loss that you're looking at. Your credit control did its job absolutely perfectly. This is a currency problem sitting quietly underneath every foreign currency invoice on your book. And so it needs to be provisioned for, and it also needs to be measured. So you can't just simply hope that it will all work out. I invoiced you 10 rand, you paid me 10 rand, because we have to work out, again, in the margins, where will that loss come from? Okay, and or if it's a loss at all. You may overstate and then the rand weakens, and then you get paid a little bit more than you were expecting. So on that side, it does help but it's never always the same thing. Was it something you wanted to say, Martin?
So you can take a foreign exchange insurance and stuff like that, Amy. But once again, there's a cost attached to that. And the what ifs are always there. Let's say I take out foreign exchange insurance and it costs me a lot of money. And then nothing happens to the foreign exchange. It stays the same. So now I have eaten into my margin by paying insurance for something I didn't need. So all of these things are going to play on your mind when you start trading in foreign currency somewhere else. But as Amy just said, I mean, the volatility, just think about 70,000 Rand difference in what you sold it for and then what you get paid. 70,000 Rand. It's a lot of money.
Yeah, it's 100,000 Rand less than you expected.
And the margin, it might be your whole margin, your whole profit margin that you were looking at, depending on how small or how big your margin is. It's just that one exchange, and that is what all of this is about. So we said just now, so the country might be good, the debtor might be good, everything else might be good, and you trade, and the foreign currency eats you out. No bad debt, beautiful trading transaction, paid in time, foreign exchange killed you.
Absolutely. So there's obviously the currency risk, and only picturing the first type of currency risk is really putting yourself into a silo, because there are really, let's call them 3 flavors that we need to know about, and we need to know them separately so that they can make the full picture. So the first one is obviously transaction exposure, which is exactly what we've just looked at. So it's one invoice moving between the date that you raised it and the date that it gets paid. This is the most obvious one, and it's the one that maybe hits your actual cash flow the hardest. The second one is the translation exposure. So this is your whole foreign currency debtors book that gets reinstated in rands every time you close a reporting period. So then you're also having to keep up to date as well. So you have all these customers, maybe different countries, maybe different currencies, and you have to then translate that back into rands. And then there's that translation exposure as well. So you have to take that into consideration. Even if it's a single customer that has paid or hasn't paid or even has defaulted or hasn't defaulted, you're still going to translate that value into a rand value. Okay, and this really sort of sits in your receivables and your net worth that happens afterwards. So when you're calculating your turnover, it can affect what you're forecasted versus what your reality actually is. So it's going to sit in your balance sheets. That's where you're really going to see that difference coming in. And of course, you're going to have to explain that to the auditors as well, to say, why did we invoice X and we only received Y? What was the translation at that point in time? And then the third one is the economic exposure. And this one is really like a slow burn that happens. This is not one, it's not just one invoice or one reporting date. It's about a sustained shift in the exchange rate. So changing whether your pricing is even competitive in the market and or whether or not your margins are correct. And obviously you have to stay competitive as well. So you may have to compromise on margins in order to remain competitive in the market. And then there's that economic exposure that you then expose yourself to as well. Not that I want to scare you from trading with foreign countries. I want to encourage it, but I do want to make sure that we're doing it correctly. So if the rand then weakens and is hard against the trading partner's currency over a full year, so suddenly your competitors who are sourcing locally look a lot cheaper than you do, because now they're able to do something without having this exposure, without the transportation costs, without the rising costs of petrol, when there's a war happening thousands of miles away. They have the advantage over you. So this is something that we're going to want to take into consideration. And it's not just an accounting thing that we need to do. It's not just shifting from one set of, I know they don't use sundries accounts anymore, but when you're shifting from, using those different areas within your debtors aging and within your accounting, but it's actually a physical one to say, like, is this something that we need to do as a business? Is this beneficial to our business? What kind of exposure will it give us, both on a business exposure, so people will get to know us, but also are we able to compete if there is a local market? Okay, so when someone asks you, are you exposed to currency risk? The honest answer needs to cover all three of these things, not just the invoice that is sitting in front of you, because all three make up the full picture. Just want to see, where am I on my slide? Oh, there we go. Okay, so now let's talk about hedging. So hedging basics. So what is the risk? What do we actually do about it? And then let's talk about what hedging actually is. So the most common tool here is forward cover. Okay, so when is it worth the cost that we're looking at? That's what it is. It's forward cover. Sometimes it's called a forward exchange contract. So in plain terms, you are agreeing today on the exchange rate that you will use at a specific time in the future. So it's kind of forecasting what could be happening. And sometimes it will work in your favor and sometimes it won't work in your favor. Because then it's kind of like when you take out a bond and you get a set rate and then the repo rate drops below that rate, you won't benefit from that because you have a set percentage that you pay. So it's just one of those things that you would then have to be exposed to. So you would want to use that specific date in the future and you would match that date to your invoice that is actually due. So that is how it's going to work. To say, I'm invoicing you. What's the date today? The 20th of August. We have 30 days from invoice. So on the 20th of or 21st of August, where are we? August, September. Then what will the currency potentially be on that date? Okay. So whatever that spot rate is and does between now and then, you already have that fixed number and that's what you're going to work towards. So now look at the chart that is next to me for a second. So if you have a look on the screen there, the orange line is what happens if you do nothing. The rate will wander around over the next 60 days, sometimes in your favor and sometimes against you. And you only found out which one it's going to be on the day that it actually lands. So am I in favor or am I against on the day that it actually is required? And so the blue line is the forward cover rate. It is the flat rate because you've already locked it in right at the beginning when you created that invoice. And so you'll see that it is a consistent line across it. And because you have already locked it in, you have traded away the upside of the lucky rate, move, but you have also removed the downside entirely. So you've given yourself that set parameter and, you may fluctuate, but very slightly. So you kind of maybe overestimate a little bit and then you come in quite close. So the trade-off here is exactly why it's not an automatic thing. So you can choose which route you want to go, but forward cover costs you something. So there is a cost involved. So before you cover your deal, you may want to be asking yourself, is the exposure actually big enough to justify this? And, how far out is the payment date? Like, what am I looking at? And what does the fluctuation of the last couple of months look like so that I can forecast what the potential fluctuations will look like going forward? So you really have to be in tune with what is happening in the world and with the currencies on a day-to-day basis to monitor this. And so, you can have a look and see how has this customer historically paid you, because that's also going to give you an indication of how they could potentially pay you going forward. So that means that you may adjust, your risk as well, knowing that this customer is a good paying customer or that this customer consistently pays late. Then again, you can try to work out what that rate is going to be. So cover, sometimes people don't want to cover every small invoice. And you'll spend more time on hedging than you would even like the lose rate. So don't waste your time like saying, well, how much, when, what, how, and then by the time you're done, you've actually it was such a small deal that even if it did go bad and the bad write-off would have cost you less than what it was to do the forward cover as well. So you need to, look at the size of it. So a long dated, a huge exposure, those are the ones that we want to really put our focus on. So we want to make sure that we don't have one bad move that wipes out your entire margin of the entire deal. And then you come out with hopefully breaking even or not actually at a loss. as well. So that's what we want to be looking at, or what is the size of the deal? What is the impact on your business if you don't get paid? And then how do we forecast what the potential spend and currency is going to be when we're expected to get paid? And let's be realistic about the expected to get paid part. And take into consideration, like if they're using foreign bank accounts, how long does it take to clear into your account? So you may be expecting it to come on a Tuesday and then it comes on a Friday, and it's notorious that on a Friday, stocks and shares go up before the weekend, and therefore you may have a change as well. So also take a look at those things. So then we get to the insurance layer. So currency covers the rate, but it doesn't cover the customer who can't pay you at all. So that's where insurance comes in. And this is not necessarily only for international trade, but for local as well. As it is with your home or your car or anything that you own, insurance is that protective layer, that safety net that helps you. And you may have a choice to say, I want to do all my debtors, I want to do some of my debtors, I only want to do my foreign debtors and not my local debtors, I want to do all of my debtors. That's completely up to you. But when you're looking at export credit insurance, because you'll hear this term used a little bit loosely, and it's worth being a little bit more precise about what that actually means. So on the cover side, it's genuinely there is a buyer insolvency and for what it's called protracted default. So we speak about protracted default all the time, which is the forward-looking view of how will this debtor behave in the next 6 to 12 months. And which is like a non-payment that has dragged on past the agreed time. So you can say, maybe there's the concession of 30 days. So you can go from be in the bucket of 1 to 30 days overdue, and or we allow you to go from is it 59 to 60 days? 31 to 60 days overdue. And then once you hit the 90 days, now we start looking at protracted default. Once you've reached that period of time, and that's when we start saying that essentially to be able to get this customer to pay is going to be very, very difficult. And so they do start looking at this payment history, and we refer to it at TradeShield as payment profile information, which is how you can see how the debtor actually pays their other suppliers. So what are their credit limits that they have with them? What are the payment terms that they have? And do they honor those payment terms? And so that is what we're looking at. That's how we at TradeShield calculate protracted default, but other companies may calculate it slightly differently depending on what data that they have and what they're exposed to. And so that is what we're looking at here. And a lot of policies will also extend to specific political events as well, which is why we want to separate, what happens on the next slide coming out as well, to say, you're trading in a specific country. In that country, they're currently having a political issue, and that will then increase your premiums as well. So you might want to have a look and see, where are you trading, what kind of country is it, and what's happening in their environment. But here is where I want you to show you that you want to slow down a little bit. You actually want to read the policy wording as well. So I know lots of people get a whole document with lots of T's and C's, but you really want to pay attention to what are they saying in those terms and conditions, because it can say that, we'll only cover you if certain things happen, and this will then cancel out your cover, or we'll only pay you a certain value if this happens. And so you want to make sure that you're looking at the exposure of that and if this is likely to happen as well. To say, if a war breaks out, are we going to lose our cover? And they can change their mind tomorrow, so you can say yes today and change their mind tomorrow. So you have to stay on top of it the whole time. So you want to make sure that when the goods have, if the goods have arrived damaged or something went missing, what kind of insurance cover do you have for that? So it's not just only did I not get paid, but am I insuring the product that I've delivered? Obviously, a service you can't really insure. Although I think some singers do insure their voices and artists insure their hands, but it's generally not what we're trading in. But you do want to make sure that you're covered for loss. If you're using shipments and the ship sinks, what's going to happen then? So it's more than just, is the customer going to pay me? Yes or no? It's like, how am I getting it there? Is it on the road? Is it on the sea? Is it in a plane? What conditions will my product be there in? What packaging do I need to put it into to safeguard it? If it's fragile, will it get squashed? And again, these will then have to be drawn up in your specific policy as well, to say when will they cover you. And sometimes the value of the goods doesn't even cover the excess that you're going to pay to your insurer. So that's also something you want to take into consideration when deciding which customers do we want to insure, and what would the excess be if we claimed on it. And would that put me at a further loss than just a write-off? Because both are going to be a loss. It's just a matter of, do I have a loss of the write-off and a loss of what I'm going to pay in the excess that I'm going to pay? So it would be a double whammy. So when do you actually reach for this? So now we've said all the reasons why not to do it, but when do you actually do this? So think about a new buyer or a new customer that you do not have a track record with yet. So in markets that you are deeply unfamiliar with, think about the concentration of risk, where a handful of large customers make up most of your export book. Because if one of those customers goes down, insurance is the difference between a bad quarter and a genuinely bad year. And so if you think about whether or not you are being asked to extend the terms further than you are personally comfortable with, because this discomfort usually is telling you something, and I know Martin says this all the time, is trust your gut, which is where we've added in that common sense into our 7 C's of credit, to say you've got to trust your common sense as well. But if you are unfamiliar, but you do want to be in that area and you want to safeguard your goods, this is when you're going to use a insurance company to make sure that you do have that cover, but you're doing it with the logic of understanding how these things work. And you're, of course, going to read those T's and C's. Okay. So political risk versus commercial credit insurance. So people use these two terms around, interchangeably, and they really shouldn't, because they are protecting you against two completely different things, one being political risk and the other one being commercial credit. Okay, and political risk insurance is about the actions of a government, not the behavior of your specific buyer. So your customer might be excellent. They fully intend to pay you. They might have the money even sitting ready to pay you. Maybe they're even going to pay you cash. If you're delivering to them, they're going to give the driver a whole bag of cash. But unfortunately, it's unable to get to you, not because the customer didn't want to, but because the government maybe froze their currency, or they don't have enough cash on hand. Sometimes I've seen in some African countries where they actually don't have physical cash. They're short of notes. And so they're unable to do that. Or they've restricted transfers out of the country. Take the Strait of Hormuz, I think hopefully I'm saying that right, where you can no longer get trade through there. So there are all these different things that, that keep your buyer, who's actually a good customer, from being able to pay you. There may even be like civil unrest or war disrupting or political risk insurance. So all of this goes under the political risk and is generally used for bigger, longer data or longer dated invoices that have larger exposure. So when you are doing a project around finance and capital of the goods, this is where that exposure sits. Okay, so you're looking at a country that has years and exposure over the years, as opposed to what's just happening for the last week or two. Okay. The next thing that we look at is obviously commercial credit insurers. And on the other hand, it's entirely about your customer, entirely about your buyer, not their external factors, but specifically that company or that person. Okay, and it's about the ability and the willingness to pay. So we have spoken about this, that you have customers that have a lot of money and can afford to pay you, but they don't. That's the ability versus the willingness. And you have customers that have just enough, but they make sure that they always pay on time. And that's regardless of where they are based. So this is about the buyer insolvency. It's about protecting the protracted default that we spoke about earlier. How does this debtor pay? And are they going to pay on time? And are they going to consistently be on time going forward? Or do we foresee a protracted default? So this one is a bit more mainstream in terms of cover, and it's usually written across your whole portfolio of buyers rather than just one-time deals. And this is where most exporters carrying ordinary trade receivables actually hold with this type of risk insurance. Sometimes if you are going to be doing both, if you go exporting to a country that has issues or political exposure, you may want to do both. Okay, so you may want to get political risk insurance as well as commercial credit insurance if the buyer is something that is unknown to you. So the test here that I want you to run in your head is, if this deal went wrong, would it be because of something that my buyer did, or would it be because of something that the government did? And that's a single question that tells you which cover do you need, and or both, and then go from there when you're moving forward. So it's the process in your mind that you really have to think about before you even decide to go on that export journey. I'm going to pause there and see, does anyone have any questions or comments? What we really love, maybe you don't have a question for us, but you have a comment that could help somebody else on the call. Pop that into the chat for us so that we can help each other. This is a fantastic forum where we're all in the same boat. We're all companies that trade on credit. We all have this exposure. And so this is something that we would love for us to be able to share our common knowledge. So structuring the deal. So how does all of this actually land up in paperwork? So let's just go make it practical, because as I said, I'm a very practical person. Generally speaking, if you've joined any of my Trade Shield training, I'm the girl who's drawing pictures. Actually bought myself a little stylus pen so that I can draw them maybe slightly neater than when I do using my mouse, although I'm working on my dexterity. I said, whenever I do it nicely, I'm like, my dexterity in my hand is getting even better. So there are 6 things to build in before you even sign. So let's turn it all into the theory, into the practical, and go and actually look at what we should be checking for. So the next contract that crosses your desk, you kind of have these little light bulbs that are going to go off in your head. So one where you have a choice. Price is stable, currency is stable, where you don't have, versus where you don't have a choice, building a rate adjustment clause into your contract itself, so that you're not silently absorbing every movement that takes place. You want to make sure that theirs can say, I invoice you X, but when it comes to payment, we'll verify what's the exchange rate and then who pays for that, who lands up with that charge. And so you want to make sure that that might be a clause you want to add into your contract. Again, I am not an attorney. I would definitely check that with your attorney. It's just a recommendation. So you want to make sure that number 2 is you want to match the forward cover and the actual payment terms, not just the shipment date that might be mismatched because, something's come up. And, then you get this surprisingly common mistake that happens where you went with one date, but you actually should have worked on the other date. The third one is set a defined movement trigger point in your agreement. So it's a specific rate shift that automatically requires a top up or a renegotiation conversation, so that you're not relying on someone like just noticing that the rate happened to move. You're actually making provision for it before you even begin. The fourth one is to confirm your insurance cover is in place before the goods even get shipped out. So you're making sure that you understand exactly what kind of insurance you need, what those costs are going to be. You've built those costs into your pricing and your margin, as well as all your logistical costs and all of those things, to make sure that we are, in the realm of making money, which is, I think, why we all go to work, and that it's not tried to be applied afterwards. Because if the claim on the shipment that went out before the cover even started, you may land up in a situation where it's not honored. So that's very important to make sure that you ticked your, crossed your T's and dotted your I's before your goods have left the property. Number 5 is make sure that you've got your terms in place, that your payment terms have been agreed upon, that they actually align. Because if the risk transfers to the buyer at one point and your insurance trigger sits in a different point, then you can end up with a gap. So that's also important. So like if you have put in certain clauses that if there's a rate change and that charge goes back to your customer, then how does that affect your your claim to your insurance, because you were expecting a certain amount more? Has that been covered with the insurer, to ensure that we then make space or provision for that differentiation? And then number 6, number 6 is the place to price your insurance excess into your margin, as I said earlier, and making sure that you do that right from the beginning. Rather than discovering, oh, surprise, by the way, Mr. Customer, we have this other deduction that we didn't account for. And so what we said in your quotation is not actually what we're going to bill you. So make sure that you have your pricing before you've even given a quotation to your customer. So if none of these 6 things, they're not very complicated. I see that Renee made a comment there for us. So they're not very complicated on their own, but the discipline of doing them at the contract stage every single time before, even the ink is dry, if you're still using ink, then you're not scrambling around to try to go back in time and to make changes. It also damages relationships, and people buy from people. And that's really important to make sure that we want to get it done right. And if you follow that order to cash process, which is the foundation of credit, making sure that we are invoicing correctly, making sure that when we are shipping out goods, that we check the goods beforehand, that we get our delivery notes. So we're still following that full order to cash process, but we've got a few extra little things that we need to add in. Martin, can you just read to me what Renee has said?
I'm going to read it to you. The question is about forex gains and losses must be factored into your pricing. So that's what we're talking about, margin. When you start negotiating anything, they say, how long am I going to wait for my money? Is my margin big enough to cover the possible fluctuations in the foreign exchange? If you're not going to take forward cover, if you don't want to have that cost. And then once again, if you make that, is your buyer going to buy the product at that price? So let's, for instance, say, I'm not trying to factor in that forex cost. And my price for my can of baked beans goes from 8 Rand a can of baked beans to 20 Rand a can of baked beans. Is it going to be worth their while to buy it from me, and they can buy it from someone else at a bigger rate? So
absolutely.
Once again, when you start factoring things in, be very sure that it's actually going to be worth your while in the end of the day.
Absolutely. And there's lots of things to take into consideration that we're not even looking at here. If you're shipping goods that you're importing from overseas and you pay for a shipping container, and your shipping container is X amount in size, but your product is very heavy but doesn't take up as much volume, then maybe you want to fill in those spaces with other companies and sell your shipping space to say, I'm only bringing in one giant printer that's very heavy, so I can't put 2 printers into one container, but I still have to take the whole container. But I could fill it all up with the squishy toys. What are these things that all these children are playing with? This little dumpling squishies. Can you imagine how many squishies you could fit into a container that you're paying for anyway? So, there are smart ways of doing business when it comes to those kinds of things. So if you're shipping overseas and you're paying for that transport costs, is there a company that you could work alongside with to say, we're going in this direction and this is how much space we have in a container. Would you want to share that cost with us? So that it brings down your exposure as well, to say, we would have paid for the container either way, but now we're sharing the cost with somebody else. So things that you might want to have a look at. And again, I don't run your business, but just some tips and points that we pick up while we're doing certain things like this. So 3 things to take into your Monday. And I say Monday, even though today's Thursday, because no one wants to do anything on a Thursday or a Friday. That is so revolutionary. So we'll do it on Monday, like when you start to exercise. So before we wrap up, let's pull, the line together, because that's really a lot of ground to cover and a lot of things to really think about. So even though they're just points, there really are things that you need to then say, well, how am I going to do it? And any type of change management requires a process. So first, we want to measure the exposure. We don't want to assume it, because that's when we land up in problems. So we showed you earlier how a customer can pay you on time in full, and you can still lose the real money. So it's all about cash in the bank, which is what we do. And so you want to make sure that you are looking at that rate movement. So if you're not tracking that, you are simply just hoping that it's going to work out, that is not a good risk management strategy. And again, that is something that you want to put into your credit policy. The second one is to match the tool to the actual risk. So currency risk is not the same as the buyer risk, and the buyer risk is not the same as the political risk. So you want to make sure, are we doing forward cover with fixed rates? Is there commercial credit insurance cover that we need for this buyer? Yes or no? And is there any political risk insurance that we need for that particular country? Before we start sending things out. And then the third one is obviously at the contracting stage decisions. It's not the collection stage. It's the saying, every single thing that we spoke about today needs to be built into that deal before you extend the terms. It's not like bolted in afterwards once the rate has then already moved, once it's too late to slam the stable door once the horses escaped or something like that. And so you want to make sure that you're building that into your contract, that you've got your terms and conditions, you've made provisions for, who takes who pays the difference if the rate does change dramatically. And maybe there's like a variation to say, like, if it's more than 10% of what the quoted rate was, then we might share the cost. And it might be that if it goes, between 1 or 2% higher than what we'd expected, we absorb the cost, or you pay the additional cost, or whatever. But you need to make sure that it's outlined and explained to your customer from the get-go, so that everybody's aware of the expectations. It's all about communication. It's all about transparency, and that avoids issues further down the line. Because if we get it right at the beginning, we're less likely to run into issues where we don't get paid. And that's really what we are here for, is we're trying to mitigate our risk. We're trying to make sure that we've covered everything that we need to cover. And we should be doing that with our local as well, to say that we're mitigating the risk before it takes place. We're looking at all the potential options. And then, of course, we're making provisions for bad debt, but we're taking the factors into consideration as well. So that's a wrap up on our international credit risk series, and it brings us to the end of today's session as well. And you do have a few minutes left. Of course, I've popped up that poll for you, and so you can give us a little bit of a rating. We learn from that. We see how are we doing, how are we presenting, are we giving you something valuable that's going to keep you coming back as well, so that that we know we're doing something good and we're adding value to you. And so that is your feedback to us. And of course, you can always reach out to us on the support mailbox, which is support@tradeshield.ai. And we are so grateful for you joining and also for sticking around for the whole series. And we're excited to see you next Thursday. We will start talking about a new topic. If you have not yet registered, you can go onto our website and register now for next week's meeting as well. And if you are a TradeShield user, then we'll also see you on Tuesday with Neil for his Power Half an Hour, where we go and have a look at TradeShield specific working. How that platform works. And if you've got any questions, you can pop it into the chat or reach out to us directly. But yeah, go and have a wonderful Thursday and a great week ahead, and we'll see you next week.
Join us every Thursday from 10 to 11.